Call the meeting order. Hello, everyone online.
Hello.
Be here. I see Mark, good to see it. I see Michael Freeman's on there too. We are calling the meeting to order at 3 p.m. First of all, is there any board communication? Finance director's report.
Good. How are you?
Good.
It's copy, so I assume.
Okay, excellent. So we are discussing the quarter ending June 30, 2025, our fiscal year. There was an increase in revenues of approximately $2,000 from last quarter. Majority of the increase is a result of positive market performance and dividend income. Compared to last year, I believe the dividend but that's also for this quarter ending is when we awarded the value change. So for this quarter, it's about $5.4 million. Last year, the fair market value change was a little over $7 million. So it was down last year. Total expenditures for this fiscal year for 2025 are approximately 13.1 for an increase of 3.3 million. About 3.1 million of this is attributed to the pension payment made during the quarter, which averages about $1 million per month for just the pension payment. Return on contributions accounted for about $9,000 for this quarter, which was for 6 employees. There wasn't any other big swings in expenses. You're looking at the quarter 3 to quarter 4 comparisons. The biggest change from last quarter was really just the FEI fees, so those are about $50,000. Any questions?
I would entertain a motion to approve the minutes of May 8th, 2025.
I'll second. Was there anything that you discussed this?
That's that at this point, I think just under other business is back on the agenda. We'll just do it in motion. Right, we had a motion by Burbank, second by Ofinger to approve the minutes of May 8th, 2025. Discussion. Not all in favor, say aye. Aye. Michael, how do you vote?
Aye.
Thank you. Motion carries. Authorization of payments from retirement fund for retirement benefits. Usually we do these as one motion. Two of them this time. I'll second. Motion by Burbank, second by Pollard. Any discussion? All in favor, say aye. Aye. Michael?
Aye.
Yep. Yeah. SCI, I think that looking to promote the hands on there for SCI. Give me one. Moving over to panelists. Hi, Dan.
There we go. Can everyone hear me and now hopefully see me? There we go.
Yep.
Sorry about that. I think I was not a panelist initially when I joined.
We've all
Great.
been.
Well, I apologize on Pat's behalf. He had a conflict today, unable to attend the meeting. I believe I covered a meeting for him, want to say it's maybe 2 years ago now that I last saw everyone. So good to see you all again, for those that were at the last meeting.
Just a
I will
reminder,
go.
please call out the page number as you point out different things.
Okay, perfect. I was going to say, did you want me to share, or is everyone okay just following along in the presentations you have?
Do both. Go ahead and share.
Pardon me?
Go ahead and share your screen. That's fine.
Okay, perfect. I'll do that as well. Pages, presentation.
Oh, no, I didn't start.
There we go. Oh, okay. There we go. So I will start here on the executive summary on slide 2. Clearly in a much better spot than we would have been during any Q1 results that were presented. So as of 6/30/2025, the market value for the fund stood at just over $162 million, and the second quarter return was 6.36%, bringing the fiscal year to date return to 12.12%. Looking out over the longer term returns, very solid across the board. 1 year, 12.12, again, in line with the fiscal. 3-year, 11.46, and then 8.68 for the 5-year, 7.53 for the 10-year. And just on the right-hand side there, you can see the changes that were made to the asset allocation with the addition to the equity factor fund, which has performed well amidst the volatility and some of the correction we've seen in the large cap equities, and as well a shift in the fixed income that was made, and rates have settled down slightly. There's some pressures, as we know, to decrease rates, but definitely been a volatile period as markets digested inflation. And as we saw this morning, wholesale prices did come in as quite a surprise, which will eventually carry over into prices that consumers pay. So I don't think by any means the inflation story is over, and it should be even more interesting as we start to see some of the policy moves that have been made to date, along with if there is influence in the fixed income markets that could also have an impact on rates overall. But nonetheless, where we stand today, really solid, particularly over the past year, but even over the longer term returns. Touch briefly on the capital markets and what we've seen taking place. So if we look at where we were and the uncertainty around tariffs, so if you look at the U.S. trade policy uncertainty index, it was moving off the charts to start the year. And that is where you saw a lot of that volatility coming in, is when you have this much uncertainty over trade policy, that is going to carry over into budgetary planning. For those involved, whether it be at a municipal level, at a company level, if you don't know what your inputs are going to be, it makes it very difficult to plan for the future. There seems to be a bit more certainty, at least from an appetite, onto how much pain is willing to be inflicted based on the tariff policy. We did see those exorbitant numbers that were first announced in the Rose Garden, a walking back of that, but it still seems to be a moving goalpost. The one interesting thing that has come out of this is that numbers of, I think the trade-weighted tariff numbers are sitting around 18%. If you had said that last year, people would have been like, oh my goodness, it's 18%. But now the perspective has changed and it's like, it's only 18%. So it's interesting how perspective can shift. But the main thing is that there is a bit more certainty within markets, and we've seen now focus transition to reducing taxes, regulation, and that's where you're getting a lot of this. You could say froth in markets if you look at some of those more speculative asset classes as of late, but certainly more clarity as to what's happening. And here on slide 5, you can see the market performance overview leading through Q2. Again, a really solid story overall, with the exception of commodities in the second quarter. Everything positive, as we saw again, more certainty and clarity in markets and a walking back of a lot of the policies which would have been very harmful to the global economic picture, particularly here in the US. But the one interesting thing to call out is the World Equity ex-US. You can see that is the leader over the past year and in the second quarter. It has been quite some time since we saw sustained outperformance from global equities. Some of it has to do with the weakening of the US dollar, but there's also just more promising news coming out of places such as Europe, as there is an appetite to invest locally, defense spending being one, but defense spending leads to technology, industrial production, and really can buoy the whole economy overall. And as we look back, here we're sitting today, clearly in a much better spot, but it's important to remember constructing portfolios in the asset allocation should permit to feel more comfortable when equity markets are volatile, and they are going to be volatile. If equity markets were just linear and went straight up, it'd be similar to a CD. It'd be much more a much more relaxing asset class to be in. But this is looking back at the past 53 calendar years, and you can see the number of times that the 10% mark was breached on an inter-year basis, and the number of times the 20% mark was breached on a looking over the past 53 years. So 10% more than half the time, 20% about 25% of the time. So when we do have these volatile markets, again, thoughtful portfolio construction should help weather those downturns, allow the confidence to stay invested. And as we saw, we approached that 20% drawdown from the highs, but where we sit now, that volatility has worked in the other direction. You can definitely see that in those 1 year and fiscal year returns for the fund. So really being patient and not panicking. It was the first time in quite some time where some of the funds I worked with reached out in April saying, what should we be doing? Is there something that we should change? And really all that work you do when you have those asset allocation studies and you're looking at those range of outcomes, you are constructing a portfolio that A, is primarily going to meet your return objective, but do so in a risk conscious way. And that's why you spend so much time on setting that top level asset allocation. And you can see here what panic can do on slide 7, what panic can do to you if you are to react in volatile markets. And, you know, imagine you had freaked out at the beginning of April, sold out of equity markets, and we're still sitting on your hands today when you've seen making new all-time highs. This is looking at the past 10 years. The result of missing the 10 best days, you would have 54% less. If you missed the best 20 days, you'd have 73% less, and missing the best 30 days, 83% less. So just 30 days of the past 10 years, a lot of days, missing those huge days in the market. And we saw it in April when you had that 10% upswing, and there was really no looking back from there. So again, having an asset allocation that you're comfortable with should ensure that there is no panic during these volatile markets, and really allowing things to play out and staying the course over the longer term. And then moving over to the fixed income side of things, one interesting dynamic that is playing out, as I mentioned, there's a lot of pressure on the Fed to cut interest rates. See predictions anywhere from 1 cut to 3 cuts this year. Again, when you see inflation numbers coming out like they did this morning, is there really that? Would it be sensible to cut interest rates when inflation is still present? There are people that are much more powerful than I am to make that decision. However, we have seen interest rates still trend downward on the short end. If you look there, you can see even from last year, last year is the dark grayish blue line, where you can see the shorter term rates were elevated, and as the Fed has begun their interest rate cutting cycle, you can see where they stood at 6.30, which is the light blue line. We've also seen some longer term interest rates increase above where they were previously, and that can be signaling of some discomfort around inflation expectations. And also, you know, growth would also be impacting long-term rates, but still important to keep an eye on. And again, this is the fixed income portfolio is diversified across, I would say, the mid to short end of the fixed income universe. And another thing that's going to be driving fixed income that was particularly in focus as the most recent bill was passed, is just government spending overall and how difficult it is going to be to cut. If you look here in 2024, the actual spending, there's not a lot of whole room to cut. If you look at Social Security, health programs, which they're managed to find some cuts there, it seems. Net interest, got to pay the interest that you owe. And once that spending is in place, it's very hard to remove it. And the pressure on government spending and the need to issue debt, you could also see that drive interest rates up over the longer term. This is a much longer term dynamic. And another interesting bit of commentary that I've heard is tariffs, now that they're in place and they're generating, let's say $400–500 billion of revenue, Congress is going to allocate and spend that money. So even if a new administration comes in that doesn't have those beliefs, how do you turn around and suddenly get rid of $500 billion of revenue? So that adds context to this. If once spending is put in place, it's very hard to remove it, and it often ends up on autopilots. And we saw that even DOGE itself had difficulty removing spending. And again, this will have impact on the bond markets over the longer term. And you saw that spike in interest rates in April as a product of this, of is spending going to get completely out of control without a way of funding it. And it speaks to, again, having that diversification within fixed income and being sensitive to the interest rate exposure. Any questions on the economic overview, what we're seeing? And
one real quick, when you talked about the yield curve, is this a healthier yield curve than what we've been seeing in recent history?
Yeah, I would say it's healthy. I would say it's more of a natural yield curve. You typically want to see, so the whole thing about the yield curve, when you say healthy, it's with the exception of the most recent inversion of the yield curve, it's typically an indicator of a recession. When you see an inverted yield curve, and again, it was a great predictor and it did not end up, well, you could argue there was a brief recession. So yes, there's not that same overhang of a known recession indicator with an inverted yield curve. And as it should be, you want to have some term premium baked in. And if you're going to lock up your money in longer term yields, you should be compensated for that. So it is healthier in that sense. Now, the reason why the yield curve has changed direction could be for, again, if you look at the longer term yields coming up as a result of expected inflation and a blunt force lowering rates. Again, rates were going to be cut anyways. I think that it was arguable that the Fed was in consensus on that. But if you should see it get any steeper, which is what our view is, that could be external factors that it may not necessarily be happening for the right reasons and could create further problems down the road. Particularly if you had, what you could have is a very steep yield curve, is if shorter term rates, which is the only thing that the Fed can cut, or the only policy they can implement other than going out and buying bonds to control the longer end, you can have a case where rates are coming down and the market sees that as letting longer term inflation get out of control, and you can see the mid to longer term component of the yield curve really get away from the market itself. But yes, I would say overall it's much more natural, and you don't have that concern over the inversion leading to recession.
Thank you.
Any other questions there on the economic overview? Okay. Moving over to slide 12 at the portfolio summary, you can see the cash flows and the gains and losses. So for the 1 year period, started at $149.5 million, and net cash outflows, mostly in the form of benefit payments, close to $5 million, and then a gain well offsetting that of $17.7 million. That's how you arrive at the ending portfolio value of $162 million. And doing a bit of a deeper dive on the investment returns, As I mentioned, the equity factor allocation fund has been beneficial since its inclusion. If you look over the past 1 year, as mentioned, there's been a ton of volatility in equity markets. If we think April being a great example of that, and some broadening out into other sectors, financials started to do well on the back of deregulation. There wasn't as much of those 7 mega cap technology stocks leading the way. So you see the U.S. equity factor allocation fund over the past year added about close to 200 basis points of alpha over the index. So has been beneficial. What you can see though in the near term numbers of that, and as we saw this roaring back and a risk on in the past 3 months, some slight underperformance there, but that's to be expected when you have kind of a euphoria, which is what we have seen over the past 3 months. And then over to the fixed income, you can see with the limited duration and the core fixed income, still pretty balanced in returns. But as those shorter term rates have come down, you're going to get higher yields out of the core fixed income fund. And even with, as we mentioned, some of the volatility in interest rates that we've seen, slight outperformance of the limited duration fund relative to the core fixed income fund over the quarter. Another great thing to point out, though, is the diversity as mentioned within the fixed income markets. Looking at emerging markets debt and the high yield bond fund have been quite additive relative to just traditional fixed income, with emerging markets debt 14.2%, high yield bond 10.79%, both outperform the benchmark on a relative basis. So having that diversification there has picked up quite nicely for fixed income and just alternative return engines in the portfolio overall. That concludes my top level remarks. Not going to go through all the calendar year returns, and happy to address any questions. Again, solid story, whether you look at it from an absolute performance basis or a relative performance basis over the past 1 year period, wrapping up the fiscal year.
Dan, I'm Mark Forkey, hearing more on the defined contribution side, but discussion about expanding use of alternatives and private credit and private debt and crypto and things like that. Any discussion at SEI on we use the real estate kind of as the traditional alternative, but any discussions on broadening that out at all?
Yeah, I would likely leave that to John and Pat as part of the broader asset allocation conversation. We've been investing in private equity for over 15 years now, and then the other spaces would be, private equity and private debt are the big ones. Those are, grabbing all the headlines right now, particularly as this at the bill it's providing access. And then of course with crypto, you have the Genius Act, and then I think Harvard made a pretty big investment into Bitcoin to, add to the list of other headline making investments into Bitcoin, all the treasury companies. On the crypto front, that is not something that we are actively. I know that as a company, just in some of our other, again, we have an asset processing business. Sure, blockchain is something that they're actively looking at, but from an investment story, have not seen much from outright crypto investing. But we still do. From the private equity standpoint, we do believe in that as a long-term, not only a diversifier, but some alpha generation opportunities relative to public markets. I think what you're mostly seeing with headlines now is the democratization is the big term being used. It's important to remember that when you are investing in asset classes like private equity, just with how opaque it is, you need to have a ton of personnel and the ability to do due diligence, just because there is such a vast dispersion. For large cap US equity managers, you might get a 2% delta between the haves and have nots, but in private equity, it could be 20%. So it is something you need to, go into mindfully and do so in a program where you have not just investment people, but you need, due diligence individuals that are able to look at all the operational risks and everything beyond just the investment component of it. So we do actively invest in private equity, not within this fund, but we happy to mention to Pat and could share some of the goings on that's happening in the space and how we see it fitting into portfolio management.
Great. Yeah, thanks, Dan. I'll reach out to Pat and maybe prep for our next meeting. We can bring it back up.
Perfect.
We're not advocating for it, just was curious on your
Yeah.
stance, and we've been getting a lot of questions from our clients as well.
Yeah, again, we've been doing, I think we just are in the process of wrapping up fundraising for our seventh private, we have a fund-to-fund program here at SEI. So, again, just for our OCIO clients, and it has done very well for them throughout the history of it. More recently focused on, LBO, VC for the most part, and then we'll have kind of an opportunistic, which in the most recent one, there was some private debt in there, just based on where yields are at and an opportunity there. But yeah, pretty robust program that we have at SEI.
Great. Thanks, Tim.
Yes.
You need to I'll share my screen now if there's no other questions for SEI. Can you all see on my screen or no?
We can see it.
Yep.
Yeah.
Okay, awesome. As is the case normally, our presentations line up, SEI's and SageView's line up pretty carefully. So I'll probably just a couple highlights, just to supplement what Dan covered. As a reminder, SageView serves as a registered investment advisor, kind of oversees the SEI and provides monitoring of the underlying investment funds. But coincidentally, all look amazing. The results, as Dan walked through, look great from an overall portfolio standpoint, but also from an individual holding perspective. So, yeah, a couple of probably being a little repetitive, but really strong equity returns. The big story this year has been the outperformance of international, which we haven't seen a lot. We get it's about total 17% allocation to international stocks. So that's been obviously beneficial. All eyes on the Fed, kind of getting sick of the back and forth between the administration and the Fed, conflicting numbers. And it'll be interesting to see kind of, some of the data points coming out the next month or so before the Fed meets in September. I think we're probably in the camp that, probably see one cut of 25 basis points. I don't know if there'll be enough evidence supporting the need to cut twice. And I think the Fed's going to be, pretty cautious, especially with some of the inflationary worries, unless you start to see some really softening of the employment numbers, which we really haven't seen, a little bit in some pockets. So those are kind of the major themes for the quarter. SageView's take on, mid-year where we were. We did, if you remember from our chart last time, we had 4 positives and 2 neutrals. We've kind of moved a little bit negative, and these things could slide back as more information is known. Still inflation under control, but starting to see some pressures there. And we haven't felt the full effects of tariffs yet. We'll see. Corporate profits have been strong, but again, tariffs might put a bite in some of the multinationals. Who's going to pay for those tariffs? Will it be the companies? Will they pass it on to consumers? Will it be a combination of both? And then what's that going to do to us all? We're very good at spending money in the United States, but in certain areas, prices may get higher, and we may be buying less things. From a negative standpoint, there's some negatives and some risks out there for sure on the horizon. So happy with the results so far, but kind of cautiously waiting into the second half of the year. We think we're going to start to see some slowdowns in some of the economic data. The market's kind of pushed back that and been really resilient, so we'll see where that goes. I'm not going to cover much in the returns. I think the major theme here is the outperformance of international over the year-to-date 12-month numbers. Looking out longer, 3, 5, 10 years, the U.S. is pretty much dominated still. It's going to take a little bit sustained rally to kind of make those numbers a little bit more similar. And Dan did a good job covering the yield curve. It's like we have the exact same data points in different formats. So pretty identical. And yeah, I was going to say from the question on the yield curve, definitely looking more normal, you know, kind of odd, still seeing that high. Short-term rates being so much higher than kind of intermediate rates, but I think the next year or so, the Fed will probably address that and lower rates. So there is a couple bullets in here about crypto and alternatives. We kind of covered that discussion. So I will skip by it. Covered assets, asset allocation we covered. Again, Sage's major role here is to kind of look at the underlying holdings of the plan to look at how they perform versus their peers and their benchmarks. We look at 9 criteria specifically for actively managed funds. That includes performance, of course, and risk-adjusted performance, consistency. We look at expense ratios as well. From there, we score all the actively managed funds from 1 being the best to 100 being the worst. And on average, the SEI funds in the plan are in the 21st percentile. So top quartile, the way you can look at this is on average, the SEI funds that we're using beat not 79% of their peer in their respective peers. So that's obviously a good number. When we blow it up and look at individually each fund, let me try to get that a little bigger. The results are good. So if we look at the SEI limited duration bond fund, we compare that with its peers. We score them 9 different ways, from performance, consistency, risk-adjusted performance, how they do in good markets, like we've seen the last couple of months, how they hold up in down markets, like we saw, or down months, like we saw earlier this year and in 2022. Batting average for baseball fans, kind of a consistency metric, and on how you do on a month-to-month versus your competition, and of course, expense ratio. So these are all rankings. Lower is better as you read through this. And you can see from a fee perspective, especially, all the actively managed funds are, you know, in the top 10th percentile, cheaper than more than 90% of their peer groups. And then the overall scores, what we're looking to do is we want our funds obviously to be top or second quartile. Anything that goes into the 3rd quartile or 4th quartile, we put on our watch. We really haven't had much on our watch list. We did have the emerging markets a little bit, you know, had some underperformance versus the traditional category. But this fund was only added a couple of years ago, I think 3 years ago, to the portfolio. It's actually provided some really good diversification benefits versus US fixed income. And that fund score has actually improved almost to top quartile. So we had that on our watch list. It had registered a couple of 3rd quartile scores. We've taken that fund off our watch list. So these are really solid results, almost everything in the top 3rd. And we've got half of the funds top decile, outperforming the majority of their peers. For index funds, we have a more simplistic look in scoring. It's mostly based on expenses and their tracking error to their benchmark. All the funds pass our scoring there as well. I think I jumped ahead too much. Yeah. So from our watch list perspective, again, the emerging market debt did have some scoring. It's a smaller category, so the rankings fluctuate a little bit more than some of the large cap US funds, for instance. So we've taken that fund off our watch list, as I showed, back almost to top quartile from a comparative standpoint. So that was it from a SageView perspective. Any questions there?
Anything, Michael? Okay, thank you.
This probably is not a question, and probably I should have raised it with the analyst with Mark. You know, Dan said, you know, the performance has been solid where we stand today, and I guess that's my concern, and I'm sure it's everybody's concern. Future expectations. I've been on this board for over 20 years. Things just feel very different right now. I'm not advocating we, you know, make a 180 and do something different. I'm just really expressing my concerns. I'm not really big into the stock market at all. But I get the sense the stock market and other things like the market, dividend return, their current performance is really masking, in my opinion, what's really going on. My guts, and I don't mean this as a political statement at all, and I have no solutions. I'm just kind of expressing a concern that things just don't seem normal. And I don't get this, and I understand things go up and they go down, but my sense is there are real long-term damages that are happening that we're not fully aware of, and we may not know for years. And all the nonsense, tariffs and call for interest rate reductions and China and Canada is really troops being deployed to city. It all just seems to me that this is different than the 53-year look back that got presented to us. And again, I don't know what to do with any of this, because I certainly am a big believer in staying the course and don't make any rash decisions, but this just feels very different. That we're too close. If the market wasn't doing as well as it was doing, I think there'd be a lot more concern that people would have, I think, about all of the dramatic changes that are being talked about, threatened, all the flip-flopping back and forth. At the end of the day, we all know who's going to pay for the tariffs. For the most part, it's not going to be businesses. It's going to be, the buyers of products and goods. You go into stores now, and even though tariffs have not taken effect, stuff that's made in China that came over here with a price on it, the price has been ripped off in most cases. And new prices have been added. And so maybe there is some price gouging going on in anticipation of things that are going to happen in the future. So once again, I apologize. I'm not looking. I know there are no, or my sense is there are no answers. And I'm sure you guys are keeping track of this and you have access to much better information than I certainly would have. But on top of it, we're finding out almost daily that when people come forth with what they think is happening, they soon lose their job. And some of these people that have lost their jobs, I would imagine they're the ones that have been developing the information that you guys are using to kind of assess what's going on in the real world. And I'm just concerned, as I think we all are, that this is probably not normal. This is self-inflicted damage, again, in my opinion. And what we're seeing happening in the market is to some degree masking potentially the longer term implications of all this craziness. So I'll stop there. I have no solutions. I have no recommendations. It just feels very, very different. So thanks for.
I think that's a pretty pervasive opinion.
Maybe a more, building on that, but a more direct question. Is the recent firing of the chief economist, Bureau of Labor Statistics, and the replacement of somebody who's questionably qualified. What alternative sources of data do you guys have to help perform if we find out that the government
Stump you?
Well, they're double.
Clear the question?
Yeah, I don't know if I heard the final question.
Well, if we find out that the
Books are cooked.
for one reason or another, we can't rely on government numbers. You guys are there a reasonable set of third-party analytics that give you a view to performance of the economy such that we don't have.
Dan, I'll let you, I'll let you take that.
Yeah, so I mean, I think the thing is, for one data point is not the be all and end all as we see, because if we look at inflation numbers that came out most recently earlier in the week, they look pretty good. Now you have another measure coming out that was running hot. So I think it's important, and I think the frustration, or at least the alleged frustration, is that you have all these revisions that take place because as these numbers filter through, you're waiting on, it's like it's tax filing data, and that's why you have these major revisions, which is just, I think a lot of employers stop reporting. It's voluntary, and then the data gets pulled in on a huge lag, which you're kind of making decisions based off of very old and stale data, and that can be revised quite a bit based on what comes through. So I think it's a much bigger conversation that you're having, and that would apply to faith in institutions, which is well beyond my pay grade, or philosophically to speak about it in the setting. But I think for the most part, there's so much access to data, and still a lot of reliable sources that are nonpartisan. I guess the BLS is in that arena as well, that you can still derive some information but by what is going on. And for example, banks are going to have number of credit card swipes, you're going to have airline travel information, you're going to have a lot of indicators in the economy. Is labor an extremely important part? Yes. But corporations and investment research, I'm sure there are many different avenues to go down in order to get reliable data. But kind of to your point on feeling uncomfortable about the future, that's the reason why you diversify. If you'd ask someone, and I even had some funds I work with that are ready to throw the towel in last year on global equities outside of the US, and it was very, very hard to think of a catalyst. 2 years ago, if you'd asked someone, why are global equities not going to perform, you'd be very hard pressed. And I think what we've seen play out over the past 6 months, and that leading to global equity outperformance, there's no way anyone could predict that. And if they could predict that, you would have to question their honesty if they said I had predicted this, or they were very lucky, which is why you diversify, because you do not know what's going to happen. And I think we saw that with the pandemic. You had no idea what's going to happen. You had no idea that it was going to create inflation that could not be created despite best efforts. That's why you have exposure to these different asset classes, and you see, again, these global markets. I mean, right now the trend is still up, but you're getting extra added value relative to just U.S. equity. So the uncertainty speaks to why you diversify, and should make you more comfortable, as there is uncertainty in very concentrated parts of the world. Just so happens that that part of the world is the biggest economic power and by far the largest U.S. equity market. But again, it really just validates why you diversify.
Yeah, that was a note I was writing down as well. I mean, when we look at the portfolio, it's pretty insulated. I mean, there's going to be years like 2022 where diversification doesn't work, but generally most of the time it does. About 56% in equities, not a huge exposure, and then that's diversified further out by country, size of company. Even if we had to question the accuracy of data, at the end of the day, it's earnings of companies that drive the stock market. So, the stock market is pretty efficient, and if the economy is going one way and people aren't buying products and earnings are down, that we'll see the equity market come down. From a fixed income standpoint, there's levers to pull too. So not only from a portfolio standpoint, could we potentially change, an allocation maybe, but that's driven more about, what we need this money for in the long period. That's what we're trying to solve for with the allocation. We know we have future benefits we need to pay out. We know we have a limited number of dollars to make that work, and that's why we rely on the actuary for that. But on an individual fund manager, they can avoid certain sectors of the market. They can overweight or underweight certain sectors of the market. So there's individual levers within each fund. From a fixed income standpoint, they can avoid certain countries. They can avoid, lesser quality debt. They can shorten the interest rate duration if they think rates are going to rise, or they can go a little bit longer and take advantage if they think rates are going to drop. So I agree. The world is a scarier place as of late, and there's different risks on the table. Tariffs, we haven't seen anything like this really ever, definitely not in our lifetimes. So I think it's a little bit of a wait and see on exactly what impact they have on the economy. Because all the things we talked about today are kind of intertwined with interest rates and the employment market, growth rates, things like that. So hopefully that quells your fears a little bit. I think that diversification that's the best thing we know how to do from an investment standpoint. It's tested over world wars, pandemics, and a lot of different parts of history. And diversification generally holds up pretty well in all types of markets to limit losses. Not to say we'll have losses again, but the point is to limit them and to stay on track for our future liabilities.
Thank you, appreciate it. Okay, on to other business. This was actually 7.1 was actually on our last agenda. We need a motion to accept and file the report. So just correct motion used last month on that.
Burbank.
By Burbank, second by Opinger. Any discussions? All in favor, say aye. Aye. Michael?
Aye.
Motion carries. Is there any other business to come before the board? If not, I entertain a to adjourn. Moved by Ophir, second by Freeman. All in favor, say aye. Aye.
Aye.
Get adjourned at 3:47. That's a time countdown. Thank you, everyone. Talk soon.
Seeing everyone again. Thanks.
Bye-bye.
Thank you.